What's up, everybody? Welcome to Heresy Financial. My name is Joe Brown, and today we are going to be looking at a few indicators that are showing inflation is really starting to pick up steam here. If you've been around the channel for any length of time, you know that the progression of inflation starts normally with the expansion of the monetary supply, either by the central bank or by bank lending, fractional reserve lending, and then that results in investments, which misallocation of capital and resources. So that causes asset price inflation. Then that spills over into the inflation in goods, in services, in materials, in products, the stuff that people actually buy. And then after that, inflation usually bleeds its way over into wages. So wages are the last thing to get hit, which means that the people who can't afford to make ends meet are hit the hardest because their wages don't rise until after everything has already gotten more expensive. So it prices the poor and the middle class out of investing. It makes it harder and harder and harder to invest as asset prices go up, and the cost of living just to buy your basic necessities goes up. So what we're seeing now is that second phase where asset prices, obviously everybody can look around anywhere and see asset prices have exploded in the last couple of years, couple of months, couple of decades, and that is starting to bleed over into inflation in just regular good old stuff. And if you've been paying attention to politics at all, you know that they tried to get a $15 minimum wage put in this last stimulus bill that didn't get passed, which means that as inflation picks up, something like that is much more likely to happen in the next one. So we're going to look at a couple of these indications that show inflation is really starting to take off. Ready? Let's dive in. All right, so this first one that we're going to be looking at is Germany's wholesale prices. If you take a look at this chart, you can see Germany's wholesale prices rose 2.3% year over year in February. So this was the first positive number since January of last year, and it's the fastest increase since December of 2018. And looking at this chart, you can see this is a quick reversal with a lot of momentum behind it. This isn't just a spike that happened out of nowhere. This reversal has been building momentum, and so it's got some steam behind it. It's got some momentum there. Now, next we're going to be looking at the 5-year break-even rate. And you can see here, if you look at this chart, the 5-year break-even rate, it has soared to its highest since July of 2008. Now, this data is widely available for anybody, which makes it even more comical that somebody like Janet Yellen is saying that there might be a small chance of inflation, but really there's no real risk of it, and if it does happen, it's manageable. Meanwhile, countries around the world are highly critical of the monetary policy that the United States is engaging in, specifically China and Russia. And in fact, Russia is doing the opposite right now. They are currently considering faster rate hikes due to inflation concerns. Now, just in case you're wondering, as a side note, there's an ETF for everything. So if something like this gives you more confidence in maybe, let's say, Russia's economic future than the United States, you can put a little bit of money in a Russia ETF like RSX. Especially in the United States, there's an ETF for almost anything. And so pretty much any idea that you have or something that you come across that says, hey, that looks like a good idea, or that looks like something I'd like to try investing a little bit of money in, just go to something like ETFDB, etfdatabase.com, and you can see if there's an ETF available for that specific investing idea. Now, looking at a country like Russia who is taking inflation seriously and considering raising rates as a result of this, you might be thinking, hey, well, Janet Yellen must be onto something then, especially considering the most recent inflation data said, hey, it's 1.7%. That's still under the Federal Reserve's elusive 2% that they've been trying to get for, it seems like, eternity. But as with any index, you have to break it apart and look inside of it to see what's going on. And if we look at shiftgold.com, you can see that Peter Schiff recently posted a blog article where he broke down very simply what is inside the CPI. And we have 3 large categories here. One category is makes up about 11% of the CPI. That's going to be durable goods, so things like computers, cars, airplanes. Another section of the CPI is going to be non-durable goods. That's going to be things like food and energy. And then that's going to make up about 27% of the CPI. And then services account for the rest of the CPI, about 63% of the CPI. And that is things like rent and healthcare and cell phone services, things like that. That's about 2/3. Services about 2/3 of the entire CPI, which is an issue because we're coming off the heels of a year where services have gotten hit hardest compared to any area of the economy. So obviously, when you're taking 2/3 of an index that's hit the hardest, you're going to have that mute the rest of the inflation that the other parts of the CPI are showing. In February, food prices are up 3.6% and durable goods up 3.3% from a year ago. Now, really the reason behind this is simply because many people have gotten large checks from the government. Household wealth is actually up, savings are up, income has been up even despite the last year of real economic hardships. The Federal Reserve is printing a bunch of money that the government is using to send out to people in the form of universal basic income. And they're in the process of doing that again as we speak. Now, this means that even though we've had a period of time over the last year where spending has been quite muted simply because of COVID and the government lockdowns, that means that we are entering a time where, number one, there's a lot of money waiting to get spent, and number two, there's a lot of eagerness and willingness to spend that money. Add on top of that the fact that the suspension to the supplementary leverage ratio, the SLR, that allows banks to hold a much smaller amount in reserves compared to their liabilities, their base equity compared to their leverage ratio. If that doesn't get extended past March 31st, banks won't be able to support the amount of deposits that are coming in from the $1.9 trillion of new money that's getting injected into the banking system, which means you're likely to see something like negative rates imposed, especially on small bank accounts. Which means that all of this new money coming in, especially to individuals' accounts, there's even more of an incentive to spend it, because if you leave it in the bank, it's going to start getting charged fees and dwindling away. This is why it boggles my mind when people talk about the velocity of money. Not only because the velocity of money equation that predicts that you need velocity of money to spike along with an increase in the supply of money for inflation to happen, which is just preposterous because the way that it's calculated is calculated via GDP, which is calculated by an increase in the money supply. And so just from a mathematical standpoint, it's an utterly meaningless concept. But even from the standpoint of common sense, broke it down in a great tweet by George Gammon a while ago. Somebody's selling 2 widgets in 1 year and for $2. The next year, he sells 1 widget for $2. Prices doubled, but GDP is the same. Money velocity dropped, but prices doubled. So just because money velocity drops doesn't mean you can't have an increase in prices. That's preposterous. Finally, we've been here before. Money velocity has been this low twice in the past, and both times it's preceded a massive spike in inflation. And finally, even the MMTers out there who are saying the government can print as much money as it wants because it's a monetary sovereignty and it can issue as much currency as it wants without any risk of default on its national debt. Despite all the problems with that, which I'm probably going to do another video on that at some point soon because I've previously done a video on MMT, looks like in light of what we're doing today, it will require another breakdown here. But it ignores the fundamental truth that the only reason a government can print money and use it to buy things is if people accept it as payment for things. And when you start to have rampant inflation, a government can't issue debt in its own currency anymore, even if it is a monetary sovereignty. And you think, well, that's preposterous. That's something that only happens to dictatorships or in third world countries. That could never happen here. It has happened here. Have you ever heard of the Carter bonds? Back in the 70s, our inflation was so high that nobody trusted that the government wouldn't just print more money in order to repay its debt. They didn't trust the US currency, so nobody's going to lend money to the United States government in a currency that the government controls. And so since the US government, needed spending power, they had to issue Carter bonds, which were bonds denominated in Swiss francs. They had to borrow in a currency they couldn't control, simply because there wasn't enough demand for the currency they did control due to the trust or the lack of trust in what they would do to that currency in order to repay that purchasing power, that debt. So inflation is rearing its ugly head. It's starting to show up in the stuff that people buy. It won't show up in wages until after. That's usually where the last place that inflation shows up. And any way you want to measure it, it looks like it is gaining steam. And this is going to result in more of the same, because the issues that this is going to cause is going to prompt a government response, monetary and fiscal policy, that is just a larger amount, exponentially so, of more of the same. If you want to protect your wealth from losing its purchasing power, obviously keeping it in cash or US Treasuries is probably going to be one of the worst ways to protect your money against inflation. Obviously, that can have a part in a portfolio, but historically, if you want to prevent your purchasing power from being eroded, you have to buy things like assets, specifically real assets, especially cash flowing assets like real estate, or you can buy gold, which historically preserves its purchasing power fantastically, especially in light of rampant inflation. And assets like Bitcoin could also be a great currency hedge going forward as well. If you don't know how to get started with any of these, I've got my recommended resources for trading, for gold, for silver, for Bitcoin, for real estate, all linked in the description below. As always, I really appreciate you guys. Thanks so much for watching. Have a good day.